So, we hear about blockchains all the time, but today we're going to go deep. I mean, really deep. We're heading straight into the most critical part, what I like to call the engine room. This is where all the magic happens, right? It's where a massive decentralized network actually agrees on what's true. We're talking about consensus mechanisms.
And that brings us to the fundamental challenge, the big question that started it all. Imagine a huge group of people who don't know each other, don't trust each other, and yet they have to maintain a perfect shared set of records. How on earth do you make sure everyone's on the same page, and more importantly, that nobody can cheat? This is the core problem that blockchains were invented to solve. You know, in computer science, this puzzle actually has a pretty cool name, the Byzantine Generals Problem. It's a classic thought experiment. Picture a bunch of generals surrounding a city. To win, they all have to agree on a single plan, either attack or retreat. The catch? They can only communicate through messengers, and some of those generals might be traitors, actively trying to mess up the plan. That is the exact same situation a decentralized network, like a blockchain, faces every single second.
Okay, so to understand how blockchains actually solve this crazy problem, we need to follow the data. Let's track a single transaction from the moment it's created to the moment it's permanently carved into the digital stone of the ledger.
Every transaction goes on this little 6-step journey. First, it starts with you, when you sign it with your private key. That's what proves it's yours. Then, it gets broadcast out to the whole network of computers, which we call nodes. These nodes start gathering up transactions and bundling them into a new block. And this brings us to the most important part, step 4, validation. This is the engine room. This is where nodes compete to prove the block is valid. Once there's a winner, they get to share their new block with everyone. And finally, the rest of the network verifies it one last time before adding it to the chain forever. That 4th step is where our consensus engines do all the heavy lifting.
And that leads us to the first and definitely the most famous engine ever built for this job, proof of work. This is the OG, the mechanism that powers Bitcoin, and it solved the Byzantine Generals Problem with what you can only describe as a brilliant, brute force solution. The whole philosophy behind proof of work is actually elegantly simple. It makes cheating incredibly, unbelievably expensive. See, to prove you're trustworthy enough to add a new block, you have to show that you've spent real-world resources. The security is quite literally bought and paid for with massive amounts of energy and computer hardware.
So, how does this actually work? Well, you have participants called miners who use these specialized, super powerful computers to race against each other. They're all trying to be the very first one to solve a really complex mathematical puzzle. It's basically a giant global guessing game that burns a tremendous amount of electricity. The first miner to find the answer wins the right to add the next block to the chain. And for all that hard work, they get a reward: brand new crypto and all the transaction fees from that block.
But you know, that immense energy consumption got a lot of smart people asking, is there a better way, a more efficient way? And that question gave rise to a whole new engine design, proof of stake.
This is where the whole model gets flipped on its head. Instead of proving you're honest by burning a ton of electricity, proof of stake makes you put your money where your mouth is. You basically have to prove you have skin in the game by locking up a financial stake in the network itself.
So here, the participants are called validators, not miners. They take their own crypto and lock it up as collateral, as a stake. Then, the network's rules randomly choose one validator to create the next block. And your chance of being chosen? It's usually based on how much you've staked. The more you have on the line, the more likely you are to be picked. If you play by the rules, great, you earn transaction fees. But, and this is the important part, if you try to cheat the system, the network can literally destroy your stake. They call this slashing, and it's a very, very powerful economic reason to stay honest.
So there you have it, 2 completely different engines, both designed to do the exact same job. One runs on raw physical power, and the other runs on economic trust. And as you can probably guess, choosing between them involves some pretty massive trade-offs. Let's break down this comparison. For security, proof of work is based on real-world physical costs. It's battle-tested. Proof of stake is based on economic incentives, a different approach with different potential weak spots. When we talk about decentralization, both have risks. With proof of work, the high cost of hardware can lead to huge mining pools taking over. With proof of stake, there's a risk of a rich get richer effect. For scalability, proof of stake is generally much faster because picking a validator is way quicker than a global race to solve a puzzle. And then there's the big one, energy. And yeah, this chart really says it all. The difference isn't just big, it's monumental. A proof-of-stake system can be over 99.9% more energy efficient. It uses just a tiny, tiny fraction of the electricity that a proof-of-work system does. The scale of the difference here is just staggering.
But this whole debate isn't just about technology and efficiency. The choice of an engine, it reveals something much deeper. It's really about a fundamental economic philosophy, a belief about how value should be created and secured in the first place.
Think of it like this. Proof of work is an industrial model. Power comes from spending money on external things, on energy, on computer hardware. The crypto asset itself acts like a commodity, almost like digital gold that has to be dug out of the ground. But proof of stake, that's a financial model. Power comes from owning the asset itself. It acts more like a capital asset, like a stock or a bond that generates a yield for the people who own it.
And that leaves us with this final, really profound question. These two engines, they represent two completely different visions for what digital value should be. One vision says value has to be backed by tangible, real-world work and energy. The other says value is best secured by those who already have the biggest financial stake in its success. So what's it going to be? Is the future of value built on work, or is it built on wealth?